Well, good evening, guys. How we doing?
Good, Rick. How are you?
I'm good.
Good.
It'll take me a few minutes to bring up some files here. Is this week's problem set the DCF KVD or which one is it?
It is forecasting DCF KVD.
That's what I thought. And the homework is based on the Leland Manufacturing, right? Homework quiz?
Let me find it really quick. Okay. Sorry, I don't know if I put in the name of the company. Give me 1 second.
Sure.
Yeah, it's Leland Manufacturing.
Okay. Okay. So, at the moment, it's just the three of us, but let's go ahead and answer any questions or look at any issues that you guys have.
Okay.
What would you like to look at, Heather?
So on the quiz, on question two,
Okay.
how do you figure out the Rev IC ratio? Because I have it in with the total amount, which is like the 68%, but the answer is like 1.4625. So I don't know how you got to that.
Okay. So let's look at the details here.
And the next one is also on that.
Yeah, so if we calculate, well, it's exactly what it looks like, Heather. It's so think revenue is a number, and invested capital is a number, and so revenue divided by invested capital. So I'm seeing here the total revenue is 270,000 or 270.18.
Well, it's for year 25, so it's the 418.37.
Oh, excuse me.
But it still comes out to be the same as the 68.38%.
Yeah, bear with me just a second. I want to look at something real quick. This is on the homework?
Yeah, it's question number 2. You have to like pick which numbers go with which. What does it say? Let me tell you. I can just tell you what it says. It's a match the following values with their respective labels for 2025.
Sure. Okay. All right. So is this company exhibiting a constant return to scale scenario? as far as you know?
Yes. Like when you're saying, like, are you saying like the revenue's going up
Well,
without the
the
debt?
revenues and the expenses, they appear to be rising at the same rate.
I would say yes.
Okay. Did you put together a forecast schedule for the company?
Yes.
Okay. So when you put together the forecast schedule, the revenues are rising at some percentage. What about fixed assets? Are they rising at the same rate?
Well, I guess not. The cost of goods are raising way faster than the revenues are.
Really?
Well, because I mean, it says revs raising at like 8.6%, where the COGS are raising at almost 64%.
No, 64% is a ratio. It's a forecast ratio. So let me open up Leland Manufacturing spreadsheet for you. I'm going to share my screen. And you're able to see Leland Manufacturing here?
Yes.
Okay. Okay. So that 64% that you just referenced is the forecast ratio for cost of goods sold.
Yes.
Does that mean cost of goods sold are increasing at 64%? What does that ratio mean? How did we get it?
You take the revenues divided by the cost of goods sold.
Yeah, so does that mean
Oh, no.
just the opposite, actually, cost of goods sold divided by revenue?
Yeah.
But
yeah.
Does that
no,
mean that,
I guess that just means it's a percentage of the revenue. Like
right, okay. So here we have revenue rising at some rate of change, which rate of change is our sales forecast, right?
Yes.
Okay. And it's our sales forecast and our adjustment in this case, because of the sheet I opened, let me open up another one without the adjustment. So we see, once again, it's rising at the rate of the sales. And then invested capital is net working capital plus fixed assets, right?
Yes.
And at what rate do those rise?
Sorry.
Well, no, how do you forecast them?
You forecast sorry, the thing just took over my screen.
Okay.
Alt-tab. There you go. Where is it? Right there. So you asked about.
Yeah, so I don't want you to look at your spreadsheet. I just want you to think, okay?
Okay.
If I asked you to forecast net working capital and fixed assets, how would you be forecasting those? What method or mechanism have you been using to forecast those? Do you remember?
I did this 2 days ago.
Okay. Well, it's the same on every one of these. You're increasing them at the same rate, at the rate of sales.
Yes.
Okay. So if both of these measures, so net working capital and fixed assets, they are what gives us invested capital, right? Because invested capital equals net working capital plus fixed assets.
Yes.
Okay. So if those are going up at a constant rate of sales, and if revenue is going up at the same rate, that would suggest that the revenue to invested capital ratio does not change.
Which is correct. Is what I
the ratio
had.
you observe for the base year is the same as the ratio for any year.
Yes, and that's what I had.
Okay.
That said I was wrong.
Oh, okay. Well, that's a problem.
Yeah, it's saying that it's like one. So I had 68.38%, and it's saying it should be like 1.
Okay, yeah, because you're maybe
0.4625.
So think about this: the revenue to invested capital ratio. So revenue divided by invested capital, right?
Yeah.
Okay. So revenue divided by invested capital is revenue of 270 divided by invested capital of 184.74, right?
Did I do it backwards?
Maybe.
Because my answer was right the first, like on the other quiz when I had it the other way.
Yes, you did it backwards.
Okay, so
I just did it.
If I had it right.
Yeah, I did it backwards here, and it's 68%. So if that's what you got, you did it backwards. Okay. So when
I do the other way, it says at 146.25%.
Right there. So it's a ratio of 1.46.
Okay.
Okay.
So why was it when I did the practice homework, it said it was the 68%?
Because the practice homework probably was invested capital to revenue ratio and not revenue to invested capital.
Oh, okay. I see what's going on now.
And remember me telling you guys that those are interchangeable. It doesn't matter which one you use as long as you then do the rest of the math right.
I did not remember that, but now I just realized it's because I was reading it wrong. Okay.
Yeah. Okay. Cool.
So then my next question, sorry, is on
You're good.
The NCS. I was able to calculate it or the way I don't know if I'm calculating it wrong or what, but I can't.
Okay. And again, this is net capital spending for which year?
2025.
Okay. So how do we calculate net capital spending?
Normally it's, how was I even doing it? The net capital is assets of year 1 minus assets of year 0 plus depreciation.
Yep. So here we have 325.509 minus 307.084 plus depreciation of 10.26.
Okay, I wonder what I was doing wrong.
And I'm only hoping that gives us the same number that you show.
It was 10 point. Sorry, I'm gonna put it in really quick because I must have been doing something wrong.
290. Right.
Okay, I think I was just doing something wrong. I don't know what I was doing wrong.
Okay.
Oops.
Yep.
Okay. Thanks.
Okay. Casey and G, good to see you. So Salman, let's go to a question you might have.
Yeah, so my first question I asked you the other day about the enterprise value. I was calculating and I did not get the right answer.
Okay.
So it's
and is that for this case or is that for something else?
It's similar case, but it's the assignment like you've given. I'll tell you what, it's FCF, KVD.
Okay, all right. It's the problem set. So let me bring that up.
Yeah.
Okay. So which question is that, Salman?
If you go for FMM and present value DCF of FMM.
No, which question is it?
Like
the question 4, 3, 2, which one?
Oh, this is not that one. This is wait. I'll tell you which assignment is that. So it is called analyzing for using Excel setup to valuation analyzing.
Oh, okay. So it's the Excel assignment.
Yeah, it's the Excel assignment.
Got it. Bear with me while I bring that up.
No problem.
Okay. So in the Excel assignment, and you already did this,
Yeah, but the answer you have given, so go to your without adjustment at the bottom, like, yeah. So you see that 46,388 is right, and then CVR FMM is 217 here, but in the quiz, it's also 217, but I'm getting the wrong. I'm getting 475.
Okay. And so to get that continuing value, what are you doing?
I'm doing my, what do you call, EBIT of my year, like last year, which is 25,
Good.
2025, divided by my G20, which is, it's this called EV divided by EBIT.
Okay. So I don't think that's what you're doing to get this number, or even a number of 475. What I think you're doing is taking this EBIT times a number to get 475. And that's what you should be doing. So the issue is, what number are you timesing it by? What number are you multiplying it by to get the 475?
Sure, I can tell you the number. So my
I think
EBIT,
it's 9.28, right?
yes.
But notice that this is telling you it's a model that uses a target EBIT, and I give you the target right here. So to get the 217, you're using EBIT correctly. You're just multiplying it by the wrong multiple.
I think I didn't see that. That's given.
Yep.
But it's not. Oh yeah, it's given.
It's given.
But it's not in yellow, so you have to calculate it.
Got it. Well, I know that on the WhatsApp string, somebody asked about this some days ago, and so we had a little discussion about this. And so I apologize that it wasn't in yellow for you. I'm not sure why that didn't come through that way. But in this case, this is a target EBIT. Now, had I told you to use the observed EBIT multiple, then you would have pulled 9.28.
Okay.
But in this case, I'm telling you to use a multiple much lower than the observed EBIT multiple.
Mm-hmm.
What does that tell us about that original observed EBIT multiple? Or maybe I need to back up and remind you where this target came from. Again, this was part of that discussion we had on WhatsApp, myself, and I can't remember who it was. It might have been Jason. So I indicated that the 9.25 number, or excuse me, the 4.25 number, I didn't simply pull off the top of my head. And I also didn't simply take it so that it would align fairly well with these other numbers. I actually took it because I know Leland Manufacturing well. And so I looked at Leland Manufacturing and I looked at comparable firms that have had transactions in the last couple of years. And the average EBIT multiple at which those transactions existed was at 4.25. So I went ahead and imputed it here, or input it here. And it leads me to these values that frankly does line up well, but the reason it lines up well is a market function, not so much a trying to force this deal function. So that being the case, what does it tell you about that EBIT multiple that we calculated at 9.25 or 9.28? Well, first thing it tells you, it's much higher than multiples in the marketplace for this company, right? Mm-hmm. Well, is it that the EBIT is too small? Well, the EBIT is what the company's EBIT is. You know, it's the operating income, right? So we're never going to say that's too small. So if this is the equation, enterprise value divided by EBIT, if we're going to suggest that the EBIT simply is a factual reality, then what's off here? Well, it must be the enterprise value that is off, if you will. And when we say off in this case, remember how we got this enterprise value? It was the market cap of the common at 4 1/8 and 250 for the preferred. So market cap of the common, market cap of the preferred, and market value of debt. Remember, we've talked a little bit about these numbers, although they were numbers that were assigned for the firm at a point in 2019, they're certainly not supported by our valuations, are they? So it would suggest to us that the market value, so or I'm going to say the market price, which is what these are reflective of, the market price is overvaluing this stock. It's too high.
Okay.
Do you remember at a point where we had a conversation where I showed you some numbers for Mira Dravana, where this was 2.3 and this was 1.15? And I told you that these were different than what you saw in the Excel assignments and that there was a reason for that, and we'd actually come back to that at a point. Well, we're going to have that discussion a little bit more robustly tomorrow night. But the market price for these equity shares isn't supported by market activities with EBIT. So we would say, or with EBIT multiple. So we would say that for some reason, the price for this company was too high in the market. And if this is a publicly traded stock, and I came to my man, Casey Ball, who was my wealth advisor, and wanted to buy some of this, Casey would say, well, Rick, it's a good company, but it's overpriced in the market right now. The value of the company is meaningfully less as we value it than the price the company has as the market is assessing it. Because this enterprise value is the prices of these stocks and the value of the debt. So it's the market has overvalued, temporarily or not, overvalued the stock, and we would say, no, let's not buy this stock. Okay, so Casey, do you have a question you'd like to throw into the mix? Gotta take them one at a time here.
Yeah, no, that's good. Mine's actually pretty short here. I have a question about the actual project, right? For the rubric, I'm looking at it, and there's something called production value that we need to kind of address a bit as we're going through this project. And I wanted to ask you a bit more about what that means.
Sure.
Either I don't recall, maybe we haven't learned about it yet. And we're talking
yeah,
about
you'll remember this as I say it, and you're just not recalling it immediately. So
Right.
Casey, I've come to you and said, Casey, I think that we should invest in Mira Dravana Enterprises. It is it's a economic consulting firm run by a couple of PhD economists out of the New School in New York, and it's one of the premier Eastern European economic consulting firms. I think it's got some great cash flows, got some great value. I think we should invest in it. For you as an investor, what does Mira Dravana produce?
a return.
Yeah, does it it produces cash flow, which then you can calculate some kind of a return, right?
Yeah.
So do you know any models that will let you identify a value of a company based upon what it produces? Free cash flow model, KVD model, adjusted present value model. Those are cash flow models, right?
Yeah.
Yeah. So when we talk about production value, we're talking about the value of the asset based upon what it produces for the investor. And what it produces is cash flow. Well, we're talking about discounted cash flow models.
Okay.
So you actually know rather a lot about it. You just weren't connecting those two dots.
Well, I suppose that I get it, but I'm trying to, I guess, in my mind, make the distinction between that and the other criteria as part of the assignment. Because it seems like in order to meet all the other criteria as part of the rubric, there's kind of that kind of inherently has to be there.
Yes.
Or is there some other part that you want me to directly call out?
Let me look at the assignment real quick. Let me go there.
It's specifically the third one. I can read
Okay.
it.
So what I'm looking at here is, of course, you're told you need to use some of these models. So you're already told you got to use a couple of what I would call production or income models.
Right.
And here I'm wanting you to make sure that you talk about what it is that a firm produces for its investors and why these models then these two, free cash flow and KVD, why those are relevant.
Okay.
This actually harkens back to a conversation we had the first night of class. And I know that when I first introduced the free cash flow model, we talked about it again as well, but more importantly than that, what does the firm produce for an investor? And how is it that that's important to us as managers? You can go into a discussion here that might be a little bit like what I just did with you, or you can go into a discussion here that talks about fiduciary responsibilities of managers. There's a lot you can discuss here, but you got to do something along those lines.
Okay, that's fair. Well, that makes sense. It's kind of tricky because I'm going into it, and I think I know that 1,500 words is like the minimum.
Yeah.
You said it can't be more than 3,000, but it's going to be really interesting. And I'm kind of beginning to scratch my head and go, I think that 1,500 would be hard to keep it to that, and I bet you it'll probably be more like 2,500.
In fact, you're going to find that most of them exceed 2,000 words. In fact, most of the time, this essay exceeds 2,000 words for students. If it goes over 4,000, it better be interesting. Okay. And I don't believe that you can't even begin to do the topics justice in 1,500.
Yeah,
It takes about 2,000 to 25. You're exactly right.
Okay. All right. I think that's everything.
Okay.
I'm doing Coke like I told you, and I wanted to see if this seemed right to you. Just real quick, one last kind of question of that. I'm not finding any bond information for Coke, and I know that they have long-term debt, but when trying to figure out, I want to calculate what their actual total bond value is.
Yeah.
I do Westminster Anywhere to visit FactSet. I know that was but I don't think that either it's not accessible as part of Westminster Anywhere, or maybe we don't subscribe to it anymore.
I don't know that you can get to it from Westminster Anywhere. You guys were talking like you thought you knew this, and I thought, well, that's interesting. I didn't know you could, so maybe you can't.
Yeah, I gave it a try.
You always have to be in the computer lab for FactSet.
Yeah, I think you got to be there in the CFA perhaps. So with that, and this is good for all of you to know, if you're using some kind of company like a publicly traded company, then you're going to have a hard time calculating the market value of the firm's debt. However, let me give you a clue as to something. Let me see, models. As it turns out, I know somebody that actually calculated the market value of Coca-Cola's debt. But not for this year, but you might be interested in using it for the years in which it was. Let's see, the firms. So I went to models.rhaskell.org. That's the valuation project website. Coca-Cola. And here we have a whole bunch of information on values for Coca-Cola, and then some input values. And if you go through this whole thing, you're going to find, and then there's some additional information and some tables, you'll find the market value of the debt. But I can tell you that it's extraordinarily complex to calculate the market value of debt for a publicly held firm, because Coca-Cola not only has bonds in the market, but they have a whole bunch of different bonds in the market issued at different times. So you'd actually have to do a bond value calculation on every one of their bond offerings. And you'd have to know the coupon rate, how much time is left. You'd have to know the current yield and such. So it's extraordinarily complex. So if you don't know the market value of the debt, what's your default?
Just use what I've done, because I've done the valuation, is I'm just using the total long-term debt.
There you go.
Okay. Yeah. I just wanted to check with that because that was a little bit different.
Yep, it is.
And I didn't know how to go about that when I couldn't like find sources on it. But
yeah,
that's good.
Yeah. So, but it and I'll tell you that we did build all of this using using a fact set.
Okay. Is there information in here about their preferred stock offering as well? Because that's also something that's very difficult to find information on.
Yeah, and sadly, it's for the same reason. Okay,
Oh, yeah.
because Coca-Cola, like many other companies, has more than one class of preferred stock. So I don't remember how many Coca-Cola has, but if we were looking at, say, Bank of America has 52 different preferred stock issuances in the market.
Okay.
And they
So
have different dividends. Go ahead.
What I've done, because that I suspected that was probably the part of it for the two of them, either because maybe the information wasn't easy to come by or something. Yeah. But what I've done is, I know you said we could make up a company if we wanted. I don't really want to make up a company. What I did for the valuation is I took all the information from their 2019, 2018 statements and I plugged them in everywhere that it was feasible. And where I didn't have the data, like for bonds and then for preferred stock, I used total long-term debt, but then for preferred stock, I just left that out. So my WACC is using equity and total long-term debt, and that's
okay.
So it's very different.
The only thing I would suggest to you is footnote somewhere that's what you did.
Yeah.
So if I do get curious about how you came up with it, I see how you got it. That's all. Okay. Yeah. It's actually really, really hard. There's a site. It's not preferredstock.com, or maybe it is, or maybe it's prefstock.com, that will give you detail for preferred stock offerings of every publicly traded company. But I don't expect you guys to go through and do that.
Okay. Sounds good. That was my only question.
Okay.
What I hopped on for, and so I appreciate it. And hopefully that's helpful I know there's 3 other people on here, so hopefully that's meaningful to you guys as well.
Sure.
Yeah.
Well, thank you. So, G, I see that you are on here with your phone again as well. Is there a question you might like to ask?
Yeah. I just, let me see. The first one, I just want to ask the word assignment.
The word assignment. I'm not sure I understand what you mean by that, G. I'm sorry.
You probably use the word document, the forecasting?
Yes.
Oh, thank you. So the problem set.
Yeah.
Okay. Let me bring it back on. So yeah, which one? Which part?
I think it's the number 1, the tax rate.
Okay.
I just calculate the answer is the 32, but I'm confused that why is the 34%?
Got it.
I think I have the same question.
When you say you calculated it at 32, I'm going to guess that what you mean is you took the tax paid. We'll flip down to the statements here.
Mm-hmm.
You took the taxes paid of 1.7 or 1.373 and divided it by taxable income of 4.29, right?
Right.
Okay. But up here in this question, we're calculating no plat. So I've got Solomon, Heather, and Casey with us. Do any of you recall why we would have 34% rather than that calculated 32?
I mean, I had a similar question, but I calculated tax rate differently a little bit, but I still got 32%.
Okay.
And I usually use that calculation method almost most of the time, and I don't know why I was like confused why it's 34.
Okay. Well, so let me help. So what tax rate, remember there are 3 tax rates. What tax rate is it we're supposed to apply to EBIT to get no plat?
The Fed one? Fed and state makes, I guess.
Okay. But we talked about 3 different tax rates when we introduced tax rates. There is the tax rate on EBIT, which would cause you to take the EBIT and put it into the tax calculator I've given you, and it's going to come out with a rate. And there's the tax rate on taxable income, which would cause you to put the taxable income into the tax calculator, and it's going to come out with a rate. And then there's the tax rate that you can apply by, or that you can calculate just as Xi has done, taking the taxes paid divided by the taxable income. So there's tax rate on EBIT, tax rate on taxable income, and the tax rate that we can observe that the company paid. Which of those three would we use to calculate no plat?
Should be tax rate on taxable income.
And actually it would be the tax rate on EBIT, Casey, and here's why. That tax rate on taxable income is quite a ways after EBIT, right? And if no plat is using EBIT, then we're going to use the tax rate on EBIT. And this is what that adjusted taxes. Remember what no plat stands for? Net operating profit less adjusted taxes. So we're using a tax rate on EBIT. Now we don't use a tax rate on taxable income because taxable income's tax rate is going to be affected by a company's debt and the interest expenses they pay, right? And we're trying to come up with a measure here that is not tainted by decisions of management as to how the company's capitalized. Because Heather might have bought this company and paid all cash for it, whereas Xi might have bought the company and paid some cash, which is equity, and borrowed some money. And Salman might have paid very little cash and borrowed a whole bunch of money. Well, all three of you for the exact same company then would have three different taxable incomes. So we can't use anything that's related to taxable income. We've got to use something that's further up the food chain than that, and EBIT is further up that list, of course. And then we had this discussion on the second night of class. So this would be the tax rate on EBIT. So, gee, this is just a long way for me saying that the reason you're coming out with the wrong number is you're using the wrong theoretical foundation for the tax rate. When we're calculating calculating EBIT, we use the tax rate on EBIT. When we calculate WACC, then we are applying the tax rate on taxable income to WACC and what we're doing it to the company's debt. So that the company has debt no longer is a discretionary issue. It's something we simply now have to contend with. But EBIT isn't affected by debt. So no plat uses the tax rate on EBIT. WACC uses the tax rate on taxable income. And we never use the tax rate that is observable from what the company actually paid, because that might be tainted by other decisions. For example, Casey's got this company and has this really nice taxable income, but he never pays tax on that much because he's got these tax credits. He was really nice. He went out and bought all of us, his vice presidents, bought us Teslas. And at one point he moved his company from Manhattan to Salt Lake City and got a Mongo tax credit when he did it. Well, those things affect the taxes he actually pays. So we never use the tax rate that can be calculated as a function of taxes paid. Sometimes you're able to get the right tax rate by doing that, but it's only happenstance that's causing that to take place. It's only because that tax rate you calculated is the same as the tax rate on EBIT or the same as the tax rate on taxable income. It's coincidence. Does that help, G?
Yeah, I got it.
Okay. So you probably asked me what time it was, and I told you how to build a watch. Sorry about that.
And also, I'm curious that I think it's the question now, the 9.
Okay.
From the, I think it's the free cash flow FCF. I don't know how to get the pure rate 1, the present value.
You don't know how to get which item? I'm sorry. I understand what you're saying.
Just to keep going down. Yes. Right here, the FCF. I'm not sure
Right there?
how did no, not this one. The pure rate 1. I mean the negative 0.044.
Oh, thank you. Thank you. Okay. So this column
Mhm.
is the present value of the numbers in this column, right?
Yes.
So these numbers are discounted by some rate. So here's the clue to this. You've already actually done this whole valuation. You did so up here in question number 7, right?
Mhm.
And you use WACC when you did this because you're doing it from the perspective of the firm. Here I'm asking you to do it from the perspective of a potential buyer. And that potential buyer has an expected rate of return. And I believe that in the story, I tell you what that expected return is. Where do I do it?
Number 2%, I think. No, this one.
I don't know when you say this one, I don't know what this one is. So, but I tell you in here somewhere what you can expect. Was it 12? No. No, you've been asked to return. No. Yeah, so 12% return. So this 12% is what an investor is expecting or wanting to target. You've been asked to determine if there's a way to do this. Okay. Well, that would be a required or expected rate of return from the standpoint of an investor. And so now instead of using WACC as the discount rate down here for number 9, you're going to use that 12%. Like I probably say that up here somewhere. Let's see. Oh, and I also in this, and I tell you in some of my text to get up the numbers I've come up with, then I've also gone ahead and used some adjustments. You can see how I've told you this right here. Okay, but the big difference here is that we're using the discount rate of 12%. And so if you'll put that into your models now, I think you'll see how I get this column. Remember, the discount rate from the standpoint of the firm is the firm's WACC. The discount rate from the standpoint of an investor is what the investor would expect to receive. Does that help?
Yeah.
Cool. Heather, we'll circle back around to you now. Do you have another question?
Good right at this moment.
Okay.
If I have any more, I'm sure I'll WhatsApp you, but I think the ones I had were just those 2 that I was getting stuck up on.
Cool. G, I think you started to speak again for a moment, G.
I have a question.
Oh, okay, Solomon, maybe it was you. I heard the voice. I just wasn't sure whose it was. So yeah, we'll take you next, Solomon.
So the same page, just go back to the question first for WACC.
Same page, but
yeah, just scroll up and question 1 in the same.
Question 1, thank you.
So in this, you got debt value is 55.52 million. If I'm using, there are 2 given values for bond and none of them is bringing me here. One is bringing me to 54. The other one is bringing me to 56. So I'm kind of confused.
Sure. So look at my balance sheet. Do you see why?
I have the same. And
well, are you only giving me the market value of the bonds, or are you adding the mortgage?
I'm adding the mortgage later. So I'll show you what I'm getting. I mean, I'll tell you for that. So with one value, if I add the mortgage value, it goes to 56 or something, and then my other way of getting is already 56, so I'm not getting 55.
Okay. So let me bring up the spreadsheet for this real quick. My guess is you're getting the wrong value for the bonds.
Maybe.
Bear with me just a moment.
Sure. Oh. I think I found it somehow.
Well, good. I love it when you do my job for me. That's what I live for.
It's kind of weird that when I ask you question and meanwhile I also try to do it and I find it somehow and then I feel like, oh.
It's kind of like, don't you hate that?
Yeah, I mean, I was waiting for that question for everyone to complete theirs. And I was like,
Okay.
Okay.
Casey, is there anything else you might like to ask?
No, I think I'm good for now. Thank you.
Okay. So, Casey, you're good. G, anything else? Heather?
I'm fine right now. Thanks.
I'm good. Thank you, Rick.
Okay. Well, very good then, guys. So I will see you tomorrow night then.
Sure.
Thank you.
Okay,
Have a good
night.
night.
Have a good night.
Have a good night.